Hello and welcome to this month's episode of Capital Markets View, which I'm very happy to say we've got a new system we're using, so you'll be able to see me and Taron together, literally sitting on our sofas. And also this won't need registration, so feel free to share it far and wide to colleagues, friends, your mum, anybody. So Taron, hey, how are you?
I'm good. Good. I'm very excited. This is my first video call conference in my house, so very excited.
Okay, so now the entire world can judge our art collections.
Exactly. My family photos behind me.
My random piece of abstract art. Okay, right. So let's dive into European financing volumes. So, you know what? For the middle of an appalling and sad crisis, the financial markets are doing okay. I mean, compared with 2008, where we were nothing, absolutely nothing was happening, literally. Those volume figures are quite respectable.
Yeah, I mean, it's a different kind of crisis, which we've mentioned before. It's not a liquidity crisis, it's not a banking crisis. And I agree. I think the June numbers look really good. We just finished all the quarterly data at LCD, and I think everyone is pleasantly surprised at how well the quarter ended up in terms of issuance. And, high yield bonds has been going gangbusters in June in Europe. And it was a record month, 13.7 billion. And we actually topped January. Cast your mind back to January. We thought it was such a busy month on both the loans and bond side, but we topped it and we had a really busy week. The end of June, early July, which was another record since LCD has been tracking data of 9.1 billion. So yeah, I mean, I think everyone is quite surprised.
And even though it's refinancings, I mean, as a loan person, I find it interesting that the high yield bond market is really knocking it out of the park, and the loan market is recovering. Things are happening, but high yield's doing really well. Okay, so let's have a move on to the States, figures in the States. So again, actually, in America, equally pretty good figures and high yield outperforming loans.
Yeah, I think in the U.S. as well, I was looking at the data, and it's very similar to Europe in terms of the use of proceeds, 70% for refis. And what's interesting is there was a lot of secured issuance first that was going from the loan market to the bond market. And then recently there's been an increase in the number of unsecured issuance as well. And I think the Fed has been driving a lot of this. But yeah, there's been some more M&A in the U.S. as well. 18% of the bonds were earmarked for that, and that was up from 10% in May.
Okay, and interestingly, one of our colleagues in the States said that, relatively speaking, the loan market is not firing off as much as people would like, and we'll talk a bit later about cross-border, and that's meaning that some people are coming into that cross-border market more. So let's have a look at. Okay, so this is the next slide is a really detailed breakdown of why the deals are being done, and single B versus double B, bonds versus loans, and there's some interesting detail in this slide actually.
Yeah, it's a new slide that we developed, post crisis, and I think it just shows some of the themes that we were talking about. You can see the refinancing being the same, basically matching the volumes in the first quarter versus second quarter, and you can also just see the fact that we have seen a resurgence of double Bs in the bond market, whereas it's more sort of evenly mixed in the loan market. So it's just a way to compare different types of issuance.
Yeah, and we've referred to this in the past. It's always interesting thinking about the double B market in Europe, because in America it's quite big, but in Europe it's traditionally not that large. But this slide shows, you're right, a chunky amount of double B bonds coming out. So yeah, that's quite an interesting stat. It'd be interesting to see how that develops going forward.
Yeah, because there was definitely a flight to quality post-crisis. But yeah, we'll see what happens in the next quarter.
And actually, it'd be interesting to see if some of those double Bs being issued are fallen angels, because there's a lot more of them now as well.
Yeah, we have seen a lot more fallen angels.
Okay, and the next one is the industry types. And not surprisingly, you've got healthcare, food and beverage, telecoms. So, I mean, I guess this kind of rhymes with flight to quality, the industries that people think are going to be stable going forward.
Mm-hmm. Mm-hmm.
Okie dokie. And our next slide is institutional and the mix between refis and acquisitions and buyouts.
Yeah, I think I wanted to put this one in just because it shows that there has been a mix of use of proceeds, so that in the in the loan market, it's not just refinancings. Like there have been some chunky LBOs. We've obviously ThyssenKrupp has been the one that's been grabbing headlines, but we've also seen Mass Mobile,
Yeah.
Sophia, Skyscraper, Rank. So there's there and a lot of that was put together before the crisis. And the pipeline is emptying, so there's not as much visibility on what we're going to see in the autumn. We do have Ineos's Styrolutions is buying BP's petrochemicals business, but there's not a huge amount in the pipeline for the autumn. But there's there has been a pretty good mix of deals in the second quarter.
Yeah, it's interesting. Reading LCD this morning before this call, I noticed the pipeline is pretty thin, but I'm glad you referenced Skyscraper because that was quite an interesting deal. Up from 700 million to 810, pricing tightening into 4.79, or at least that's the way I calculate the yield to maturity. So, I mean, it shows there is demand out there. In Euroland, which I must admit, I find Euroland a bit confusing at the moment. So the next slide is cross-border volumes. So the Thyssen deal, where the dollar tranche was increased reasonably, and the euro tranche not a great deal. And interestingly, I also read the story about the Carnival bonds, where the dollar bonds went from 550 to 775, and the euro bonds only went from 400 to 425. So there seems to be a lot of demand out of the States, and not Europe's doing okay, but nowhere near as hungry as the American market seems to be.
Yeah, I mean, I think we published a quick take in recent days on ThyssenKrupp, like looking at the actual deal and the deal structure and how it was put together, because I think the banks are trying to assess where the pockets of demand are and where are the pricing points. So, if our viewers want a bit more detail on that, it's a good one to read. Nina and Luke put that together, and it's very interesting. And it does talk about how the euro loan market actually provided the least amount of capital in the structure. And the fixed rate secured bonds were both upsized in both regions. So, there's more detail on that, but I think the key point is how the deal was structured to be tailored to different various levels of demand in different regions. But I think also it just shows that there is confidence that there is liquidity globally to finance jumbo deals.
Yeah. I mean, I think American liquidity very high, European liquidity not too bad. So the next slide is EBITDA ratios, and
Yes.
For me, the interesting thing about this slide is that it shows that EBITDA is kind of stable, around the 5 times from the information memorandum. Don't forget, if you dig around in the background, it's actually higher. Whereas post the past crisis, EBITDA levels and the structures of deals changed. It fell quite a lot. Whereas in this crisis, we're still getting the same kind of levels of leverage. It hasn't changed much.
Yeah, I agree. I mean, you would expect that leverage would fall after after a sell-off like we've had, and that just hasn't been happening. I mean, I would say, just to sort of temper this, is that there are a lot of add-ons in the data set which can increase leverage, because these are sort of known credits. It's just adding on to a deal that's already been structured, so that will skew the averages to look a little bit higher. But I agree. I mean, there is liquidity and demand out there. I mean, obviously there's been pushback from investors on certain terms. But, deals are still showing very aggressive leverage ratios. And I think, there is demand. And so we are going to see higher leverage than we did after the last crisis.
And so there's the story that you guys wrote about Finaxi, the auction that's in place now. And you're quoting market talk that banks are bidding at 4.5 times and that funds are bidding at 5 times. So, that leverage level carries on in the same way that it did pre-COVID.
Yeah.
Okay, so let's take a quick look at pricing. So we've now got the average single B primary spread slide up with, as expected, yields going up, and I think, I still think they're stabilizing at around 4.5%, down from about 5%.
Yeah, I mean, this is the rolling 3-month average. I was looking at the individual credits in the data last night, and you know, like ThyssenKrupp had a yield to maturity of 4.68. Bio Group had 4.96. Some were higher, but I would anticipate that when we have our next call or our next recording, that we will see the yields to maturities will probably go down, because the ThyssenKrupp priced much more tightly. And if we go to the next slide, we can talk about pricing flexes.
Yeah.
And we have seen in the year to date, there's been a lot of flexes down, and that obviously includes the first quarter stats. But if you look at the last 3 months, we have seen 4 deals that were flexed down and only one that was flexed up. So there is demand that is influencing pricing levels. So I think we are back on that downward trend again, which is surprising.
Yeah. So I noticed the Nielsen term loan B. I don't think they've finalized the pricing yet, but pricing talks between 4.17 and 4.3. So they're breaking that 4.5 barrier. Mm-hmm. So it's really interesting to see where pricing is going.
Yeah.
So, okay. And then secondary market. So primary price versus break, not surprisingly, the secondary market, below par now. But I think, I remember you mentioned the other day, that's of course because of OIDs and the technicals and the way secondary market pricing works.
Yeah, everything is being priced at a discount. So we're seeing OIDs. So that's why when you look at the average primary price in this graph, you can see the red line is below 97%. Obviously, things are still trading up because the average break price is higher. That's the blue line. But yeah, the whole market is down. If we look at the end of June figures for the LE, nothing is trading above par. Although we are seeing like 98 to 100, that's actually gone up as a percentage. So in May it was 7.8%, and it's gone up to 10%. So the secondary market has improved, but yeah, it's certainly not a par market anymore.
Yeah. Okay. And spreads on term loan Bs by size. So, the graph of that clearly shows if you're a big deal, your pricing is edging down a little bit now. And if you're a smaller deal, pricing has gone up quite a lot for you. And that's an obvious equation between size and liquidity.
Yeah, that's a flight to quality, as we're seeing. So yeah, there's always a gap between those two figures, but it's wider now.
Yeah. And then CLO issuance. So what CLOs are doing okay. We're seeing price talk on Arbor for its AAAs at around 150 basis points. So that's come all the way back in from 200 basis points. We're seeing deals being out there, certainly the volumes that we're getting through. There are, 2 or 3 CLOs. Every couple of weeks, we kind of get 2 or 3 come, then there's a break for a week, then 2 or 3 come. I think there'll be a break for summer this year. I actually think people are finally taking holidays.
Everyone really needs a break now, I think.
Oh, yeah, we're all zoomed out. But I think the biggest problem CLOs face at the moment actually is not putting a CLO together, because I think there's a lot of demand for CLO liabilities from European insurance and pension funds. I think most of the problem is actually getting paper.
Because it seems like the deals now are just the warehouse deals. So we need new issuance to fill up the rest of them.
Although very interestingly, rumors of arranging banks offering in Europe warehouses to people again. And
Mm.
that's such a great positive sign. That is really, really good. Okie dokie. Oh, and it's now the slide of the beach,
Yeah.
which is where. So before we actually finish, Taron, is there anything else you wanted to say, or any other points you wanted to raise?
No, I think we covered the major trends from the quarter.
Cool. Right. So in that case, it just remains for me to say we would all love to be on this beach, but if you're lucky, hopefully you can get away to somewhere for a staycation, a holiday within your country. Both Taron and I hope you are safe and well. We will be taking a break. We traditionally don't do one of these in August, so we'll be back in September. But feel free to send either of us any questions you may have. Thank you very much.